You've got $50,000 saved and you're ready to buy a home here in San Antonio. First of all, congratulations, because that's a big milestone. But now comes the tough question. How much of that should you actually put down? In today's San Antonio market, where the average home price sits at around $330,000, that $50,000 could go a few different ways. You could put 15% down and lower your monthly payment, or you could put down the minimum down payment and keep more money in your pocket. So what's smarter? Well, let's go ahead and break that down. Now, for most buyers, here are your options. Okay, so buyers can choose between a conventional loan, an FHA loan, as well as a VA loan. Now, with a conventional loan, you could put down anywhere from 3 to 5% down. Now, FHA loan will be as little as 3.5% down. Now, when it comes to a VA loan, which is a military veteran loan, that is actually going to be 0% down. So with VA, with military members, you actually don't have a down payment for purchasing a home. However, between these three different loans, they each will have a closing cost. Now, that's going to be a different item, which we could speak about later. But for now, we're just focusing on the down payment percentages. Okay, now let's dive a little deeper and understand the price points as they relate to these percentages. And we want to remind you that we are focusing on the price of a home being $330,000. So based on that price of a home, 3% of $330,000 will be $10,000. 5% will actually be $16,500. Okay, 3.5% down will actually be $11,550. And of course, VA is still 0% down on a home. So based on these numbers, that means on a $330,000 home, you could buy with as little as $10,000 or $12,000 down. Or if you'd like to put the whole $50,000, that's going to be an option as well. Okay, so let's talk about why putting more money down can actually make more sense and when it might actually save you more than you think. So when you put more money down, you're immediately reducing the size of your loan, which means your monthly payment on a mortgage goes down. You'll actually pay less interest over time, and you might be able to avoid private mortgage insurance. And if you're asking yourself what PMI stands for, well, that's private mortgage insurance. Now, private mortgage insurance ensures that the money that the individual or entity is loaning you is actually going to be insured. So that PMI, in case you're financing it with an FHA loan, that's going to add about $100 to maybe $200 a month. So $100, let's say, for round numbers, times 12 months, that's $1,200. And over a 30-year span for a mortgage, 30-year loan, that's going to be $36,000. Now, I also want you to understand that for every $1,000 that you put down, it's roughly about a $6 to $8 in savings. Okay, so let's move on to this example. Okay, so let's remember that the example that we're using is $330,000 for a home. So if you put 5% down, that's going to be $16,500, which ends up bringing your loan amount of $313,500. And of course, if you put, let's say, upwards of 15% down, well, that's going to be $49,500, which equals to about $280,500. Okay, so now for every $1,000, as I mentioned earlier, it's about $8 in savings. So potentially, if you put that $16,500 down, you're potentially saving $132 monthly on your mortgage payment. Now, of course, we're not considering the interest rate, the property tax rate, or anything like that. I'm just talking about general numbers because the idea behind this is what we want to do with that $50,000 that we have in savings, right? And if you put all $50,000 down on the $330,000 home, well, you'll actually be saving $400 on this example of this price of a home. So the difference in loan amount can translate to about $100 to about $400 less per month depending on your interest rate. And over the life of a 30-year loan, that's tens of thousands of dollars in savings. So now that we've discussed why you want to put more money down on your home, let's actually talk about the opposing side of why you might want to keep some cash. So now that we've talked about why you would want to put more money down, let's talk on the flip side and talk about why not putting all of your savings into the down payment can actually be the smarter move. So when you buy a home, the expenses don't stop on closing day. In fact, that's often when the spending really starts. So remember, you have repairs that pop up, even in new construction homes, but of course, you have warranties that you could utilize to counter that, but there may be items you may have to fund out of pocket. Maybe you'll need furniture, of course, maybe even a fridge, washer, and dryer that wasn't negotiated in the deal, and maybe if a resale home, that seller didn't even leave those items behind. Then there's, of course, property taxes, insurance, and moving costs, things that rarely fit neatly into your pre-closing budget. So let's say you buy a $330,000 home and you put every penny of your $50,000 savings toward the down payment. Sure, your monthly mortgage is going to be lower, but now you're left with almost nothing in reserves. So if the AC unit quits in August, and remember, it's San Antonio, that repair cost could be $1,000 to $3,000 or more. If your car breaks down or a job transition happens suddenly, you're needing cash. And of course, that's not the kind of stress you want after finally buying your home. So that's why so many smart buyers here in San Antonio are taking a balanced approach. Instead of using all the $50,000 for the down payment, let's say you put 10% down on a $330,000 home, that's $33,000. You still have $17,000 left in your savings for moving costs, emergency reserves, and a little breathing room. Now that combination gives you a strong loan profile and keeps you financially safe after closing. It covers those early expenses, unexpected repairs, and gives you peace of mind knowing you don't have to rely on credit cards or new debt right after closing. And here's the thing, you can always put more toward your mortgage later, but you can't get your emergency fund back once it's gone. So sometimes the safe financial move isn't the one with the lowest monthly payment, it's the one that keeps your lifestyle and your sanity intact. So what's the best move? If you can comfortably put 10 to 15% down and still have several months of savings, that's usually the sweet spot. But if you'd be stretched thin putting more than the minimum down, then don't force it. You can always pay extra toward the principal later, but you can't get your emergency fund back once it's gone. So if you're not sure which path makes sense for your budget, my team can help you figure that out. We work with local lenders every day to help San Antonio buyers find the right balance between a strong offer and a financial peace of mind. So if you're looking to relocate to the San Antonio area or just looking to purchase a home here in the San Antonio market, Alyssa and I would love to assist you in any way we can and just be a resource of information for you. So feel free to reach out to us with the information on the screen with a phone call, text, or email, and we would love to help. We hope you got a lot of value out of this video, and we'll see you on the next one.